The market has just opened and we see pretty much red right across the board. Now the reason for this, we did have the inflation data just being released for last month, and we can in fact see that consumer prices did rise, although very trivially by around 0.2%, and this brings the 12-month rate for inflation around 2.5%. Now there was a lot of excitement before today that we may in fact see a 50 basis point cut. However, now this is reduced and we are now seeing traders estimate around an 85% chance of a 25 basis points. So that is one of the reasons why we do in fact see the market turning red. But our focus on today's episode is going to be on LVMH, a company that we are looking to buy. As we can see, it is now trading at its 52-week low, and we're going to run through why we believe this is a great opportunity for the long term, the valuation that we see, as well as the metrics of the company. Now, for those that don't know too much about this company, you may not have heard the name, but I'm sure you would have heard the majority of the 75 brands that they do hold within their umbrella. And as we can see, these are the acquisitions they have had over the years. A very, very well-known company, especially in terms of those individual ones that they do hold. Now, in terms of the actual historical performance, we do note they are down around 17%. We're going to take a look at the investor presentation as well, talk about the results that we have seen, why there is weakness in their share price, and the expectations moving forward. So as we said, down 17% over the last 12 months. Over the last 10 years, however, they are up 286%. They have outperformed the S&P during this time. And when we look at their trailing 12-month PE, we do note around 22.7, which is pretty much in line with what the S&P is trading at right now. And we also have a forward yield around 1.8%. We also note here that Seeking Alpha do give this a buy. However, in today's episode, be aware, given this is a European company, not all of the metrics we will be able to use in today's episode. Now, before we jump in, the first thing we do want to take a look at is the CEO, Bernard Arnault. Now, he holds around a 48% stake within LVMH, and he is constantly buying shares, so we are seeing a lot of insider buying. In fact, the more recent one we see on the 5th of September, so around a week ago, and we can see he has bought another tranche on the 4th of September, as well as buys in August. In fact, quite a significant number. We are talking about the millions. He is buying a lot, as he does believe this company is severely undervalued. And as we always say, insider buying is a very bullish signal. Ultimately, why do they buy? Well, they believe the share price will go up. So just something to consider within today's analysis. So let's firstly talk about the metrics that we typically look at. They have increased the dividend over the last full year, nice 8%, so nice mid-high single digit. Over both the last 5 as well as the last 20 years, we are seeing double-digit increases, something we love to see from very good high-quality dividend growth stocks. And when we take a look at the first metric, well, the free cash flow payout, remember we focus on this, ignore the earnings, which is susceptible to manipulation by management through accounting. We want 60% or lower, pretty much straddling around that on a year-on-year basis. Nice to note as well, given they do increase the dividend at a very strong rate, 54% on a trailing 12-month basis. So no worries with those metrics. Then we move on to the free cash flow per share, where we want to see consistent increases over the longer term, going from around $5.7 in 2014, $21.2 in 2023. So we see more than 3 times growth, and that is expected to increase over the next 12 months to around $30.60. So that is also another positive to note. When we look at the sales growth, well, no surprises here that in 2020, the only year that they did drop was during COVID, negative 17%, a very strong rebound, and pretty much the majority of the last 10 years, this company has grown double digits. Now, trailing 12 month does show 1%, and we are noticing a slowdown, something we will cover shortly in terms of their latest earnings, where they did see a very marginal increase. And for those that like to see the numerical format, well, in terms of total sales, we can in fact see nearly tripled from 31 billion in 2014 to 86 in 2023. As always, we love companies that do share buybacks, returning excess cash. Very minimal over the last 10 years, so nothing really to note, going from 504 to 500. And then we move on to the ROIC, one of our favorite metrics. Give us faith, management are able to effectively allocate their capital. 10% or more, that is exactly what we see over the last 10 years. Last 2 years, 21%, looking very good, making it very attractive to potential investors. Operating margin, as always, not just above the minimum 16%, but we do get that operating efficiency, 19% in 2014, 26% in 2023. Free cash flow margin also above the minimum 5% we want to see. Over the longer term has been very strong over the last 10 years. Then we get to the final metric for this stage of the analysis, the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization. The numbers we see here, number of years it would take the company to pay off all of their debt net of cash on hand, and does correlate to both dividend safety, balance sheet strength, and given we want to see below 3, pretty much decreasing from the all-time highs of 2014 at 2.9, down to around 1.67 in 23, 1.74, so a marginal increase expected over the next 12 months. So looking positive, balance sheet looks secure, dividend also looks to be safe as well, so no red flag indicators so far, and overall this does look like a fairly high quality company. Now the interesting thing is to look at their first half results for 2024, which they did release at the end of July. So first thing that we want to point out, so their revenue for the first half of 2024, so that is the first 6 months versus the first 6 months of 2023, they did see plus 2% growth to their top line. Remember, on this channel, we ideally want to see around 3 to 4 at the bare minimum just to keep up in line with inflation. So we can note here below marginal inflation. In terms of their profits, well, from operations, negative 8%, so never really positive. Does explain why we do see that share price drop over the last few months. And in terms of the margins, 25.6%, although we do want to point out this has reduced from the last year as we are about to show you. So let's get into it. Now what we mentioned, yes, plus 2% in terms of their sales, their top line, but given the currency effect of negative 3%, in actual fact the change in revenue is minus 1%. So just something to make clear, whilst they do show that plus 2% on the first slide, ultimately when you incorporate the currency effect, their revenue is down 1%. Then we want to show you the geographical mix. A few key points here that we do want to bring to your attention. Whilst there is a 1% increase in terms of percentage points to their sales from the US from 2023 half year 1 to 2024, the main thing that we do want to point out here is that Asia has reduced quite dramatically if you think about it, 4 percentage points from 34% to 30%, and that is one of the key drivers where we do see their top line revenue reduce as opposed to increase. In fact, we ideally want to see that double digit that we have seen from this company. Asia has had a massive effect on LVMH and in terms of buying those luxury goods, as we will show now as well through the numbers. In terms of looking at it from a different perspective, again, as we can see, the US pretty much the same in quarter 1 of 24 as well as quarter 2 at plus 2%. The one thing here, again, that we do want to point out, not a great sign, but Asia, in fact, this does exclude Japan, was negative 6% in quarter 1 this year, negative 14% in quarter 2. So a worrying trend. Is it going to be continually decreasing over the next few quarters? Something that we will have to consider, especially when we look at our margin of safety. And then we get to the actual numbers. Now, if we look at the reported growth, we are seeing a large drop, double digits, to wine and spirits. But the real key takeaway here is that, in fact, their largest revenue driver, the fashion and leather goods, is down around 2%. Now, we do also note that watches and jewelry is down. The only real positive here is that both perfume and cosmetics and selective retailing are increasing in line with inflation. As we said, though, overall, their top line has been down around 1% for that half year 1 comparison from 24 to 23. In terms of their operating margin, now again, we do have to note that whilst 25.6% is good, as we saw increasing over the last 10 years, that is below the last year number of 27.4%. So not only has their top line revenue reduced, but so has their margin. Remember, high quality companies do show us the opposite trend, increasing revenues, increasing margins. Just something to bear in mind. Now, if you were just to take a look at their headline, they do say it is up 4.5 points versus half year 2019. Not really sure why that is something that has to be on this, given the fact that we want to see more recent data. Ultimately, we would expect over the long term that margins would increase. We then take a look at their net profit. Again, we just want to show you that in line with the other numbers like their revenue as well as their operating profit and margins, net profit, so their bottom line has also reduced, in fact, around 14%. So we can start to see the environment environment that this company is in. Consumers are weakening, especially in Asia, where that is one of the large drivers of their revenue. In fact, we saw double-digit decrease just in the more recent quarter in that geographical region. So lots to think about. And then finally, we just want to show you here the decrease in their profit. Now, whilst they do say that comes largely down to the currency effect of negative 607 million, we do also see here their organic growth is down as well, around 324. So not the brightest of pictures to paint here. Ultimately, we do still believe this is a very high quality company, but we need to understand what level of margin of safety are we getting at this price. Is it one to truly consider today at its 52-week low? We also want to let you know we have released our latest weekly article. If you want access to this or any other articles, you can click on the pinned comment below to sign up and read straight away. You can also get access to our 25 undervalued stocks for the month of September, where we also run through those that sit within our portfolio. So don't forget to click on that pinned comment below. So now we just want to run through their top line revenue trend as well as their bottom line net income. As we mentioned, over the longer term, their top line has been increasing, although not very consistently. Nonetheless, nearly tripled over the period, going from 37 billion in 2014 to 95 in 2023. And then when we take a look at their bottom line net income to see whether or not that trend follows the same as the top line, it pretty much does, as we can see, moves in the right way, although again inconsistent, going from around 6.8 billion in 2014 to around 16.8 in 2023. So near a 3 times growth to their bottom line, very similar to what we saw for their revenue. Then we move on to the health of this company. Remember, total cash versus total debt. We have around 5.3 billion in 2014, around 12 billion in the latest report, so more than double from the last 10 years. No real trend that we have noticed here. And again, as always, remember, we never look at that number in isolation. It doesn't really mean anything, which is why we compare it both numerically and directionally to their total debt, which has gone from around 11.2 billion in 2014 to around 44 billion in that latest quarterly report. So something just to bear in mind. Again, another factor to add to the margin of safety. Their total debt levels have been increasing over the last 10 years. In fact, nearly quadrupled. So that is one area that we would like to see them come down over the longer term. Then we move on to what typically would give us some gradings and the metrics. Now remember, as we mentioned at the beginning of the episode, this is a European company, which is why we don't have the gradings. But a few things that we do want to point out, for example, the P on a gap basis trades around 22.6. As we can see, that is a premium to the sector around 17.7 or around 28%. Now within this bucket, as always, there will be companies that aren't as high quality, whether that's relating to their growth, their profitability, or any other factors. But ultimately, through any other valuation method that you do look at, we can in fact see LVMH does trade at a premium. Then we want to take a look at the growth. As we said, no gradings, but we can in fact note here that year-on-year growth of 1%, not great. Sector median not too far off at 2%. Moving forwards over the next 12 months, 6.2%, marginally higher than the sector median of 3.64. So not too far off the sector in terms of those revenue figures. And again, we can pretty much see the very same message there for the EBITDA moving forwards, 3.9 versus 3.82. Then how about looking at their profitability? Well, we do note here, in fact, it does look fairly decent. 69% trailing 12-month gross margin, 37% for the sector median. Bottom line as well, looking very healthy in comparison, 16.3 versus 4.49. And then when we look at their cash from operations, 20.28 billion, significantly higher than the cash from operations of the essential sector at 276. Now, we also want to conclude this part by saying that we also know Seeking Alpha do consider this a buy at the moment. Finally then, before we jump into the valuation, we'll just compare it to others in the sector to see whether or not this is an issue with LVMH or underlining in the industry as a whole. Very big name. We have Hermes, we have some other very big names in the industry. And when we look over the last 12 months of the total return, LVMH, whilst it is down, we actually note a few others are also down. So you could argue the industry has seen some share price decreases to the weakening consumer effect right across the board. As we have already discussed Lululemon, in fact, earlier today, that is a very similar trend, as well as PPRUY. Now, over the last 5 years, when we take a look, LVMH is up there around 74%. Over the last 10 years, we do also note looking very healthy, 358%, although there are some other companies like Hermes which has performed significantly better. Regardless whether or not you are happy with this over the next 10 years, do remember that past performance is not an indicator of the future performance. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $914, the way we got this, we ran it through 3 different models. We have the multiples valuation model, companies in a similar sector and size, their average PE multiplied by the EPS of LVMH to give us an intrinsic value of $918, our first undervaluation signal. As always though, do remember we're not looking at any one of these models in isolation. We then have the dividend discount model, some very nice growth over the longer term. Bear in mind they do pay in euros, therefore we do get some FX currency differences. Average growth though, as we saw, double digit, looking very healthy. Moving forwards, we've gone conservative around 6.5%, another undervaluation signal. And then we get to the DCF model with the free cash flow year on year. We have the average growth at 25%. We've gone a lot lower at 6%, which is pretty much in line with the previous year growth. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and a third undervaluation signal. So the intrinsic value here is just the average of these 3 models. And as always, you can grab a copy of this model by clicking on the pinned comment below to run your own numbers, whether it's for LVMH or any others. Now, the current price at 666, we always like to use a margin of safety to start off with at 10%, and we execute on this if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that, it is a buy at $822, but as always, we keep going till it's near the current trading price, and in today's episode, you are getting at least a 25% MOS up to $686. At the 30% mark, you would need to wait around $640. So somewhere between 25 to 30% for today's episode, with Wall Street giving this 36% upside, their price target 909, not too far off our intrinsic value. So they are also very bullish on this company over the next year. As always, do give us your thoughts in the comments below. Is this one you're looking to buy? Maybe in fact this one is on your watch list, or for whatever reason, maybe you believe that the consumer environment will continue to weaken and we will see their share price take a hit. And as always, if you do enjoy the content, values provided, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.